Are AI chipmakers playing a dangerous financial game? And is the broader market about to hit a massive macroeconomic wall? Well, welcome to The Explainer. Today, we're unpacking a really fascinating review of the market catalysts shaping the week of August 10, 2026. So, let's just jump right in.
Here's our roadmap for today's analysis. We're going to look at a macro overview and the CPI focus, NVIDIA's circular financing, Microsoft's custom silicon, Berkshire Hathaway's buybacks, and finally, TSMC's investment strategy updates.
Let's kick things off with Section 1, Macro Overview and CPI Focus. Right now, we are looking at a highly bifurcated market. Thanks to surging international oil prices, the energy sector absolutely dominated the start of the week, jumping 4.6%. But, there's a flip side to that coin. With energy prices spiking over 6% in a single day, U.S. Treasury yields shot right up along with them. The 10-year yield basically clawed back all of its recent losses, which naturally put a really heavy weight on growth and tech equities. Add in some hawkish chatter from Fed voting member Hammack, who literally suggested multiple rate hikes might be needed because the U.S. economy is at full employment, and, well, you've got a perfect recipe for market tension.
Now think back to last week. We had weak non-farm payroll data, which initially cooled off rate hike expectations. But fast forward to right now, the market is back to pricing in a 51% probability of a September rate hike, right ahead of Wednesday's critical CPI report. So why does this matter to us? Because if that CPI report comes in hot, that 51% is going to skyrocket, and the broader markets are definitely going to feel the heat.
Moving on to Section 2, NVIDIA's circular financing strategy.
NVIDIA is making a massive strategic play right now. They've secured a $500 billion financing pool with 6 of Wall Street's absolute heavyweights to fund the next generation of AI infrastructure. CEO Jensen Huang says NVIDIA isn't just making chips anymore, they are building what he calls AI factories. Simply put, NVIDIA is acting like a Wall Street matchmaker, helping data centers secure favorable loans specifically to buy NVIDIA's own GPUs. This is known as circular financing. And if that sounds familiar, it's exactly what Cisco did during the dot-com telecom boom back in 2000 to push up their market valuation. They guaranteed the funding so clients could buy their equipment.
So what's the catch here? The short-term reward is pretty obvious, right? A massive, immediate boost in sales. As long as the funding flows, NVIDIA moves product and rapidly expands its revenue. But the long-term risk is the elephant in the room. NVIDIA is essentially acting as a guarantor. If their clients buy all this hardware but fail to actually turn a profit with it, they're going to default on the bank interest and principal. And if they default, NVIDIA absorbs the blast. Ultimately, Wall Street is placing a $500 billion bet that AI productivity will actually pay off in the real economy.
Now, despite the jitters this news naturally caused for chip stocks, the technicals tell a surprisingly calm story. NVIDIA remains in a confirmed breakout position, holding strong above $216. Because the fallout from potential defaults would take a very long time to materialize, the money has to arrive, be deployed, and fail to generate returns before defaults actually trigger, the data suggest holding steady and just riding the institutional trend for now.
Next up, let's dive into Section 3, Microsoft's custom AI silicon. Let's look at how Microsoft is building a literal hardware fortress to drastically cut their reliance on external suppliers. They are aggressively ramping up their own custom AI silicon. They kicked this whole thing off with their first-generation chip in late 2023, followed up by the Series 200 upgrades. Now, the 300 series is imminent. And they aren't stopping there. They are already in talks with TSMC to deliver over 300,000 of these chips by 2027. This isn't just about saving a few bucks, it's about tailoring the silicon exactly to their internal data center needs, which greatly improves operational efficiency and builds out a massive competitive advantage.
Technically speaking, though, Microsoft stock is currently flashing some warning signs. It's overbought, with a daily-level bearish divergence. While their fundamentals post-Q2 are absolutely rock solid, don't be surprised if we see a minor pullback, maybe around 5% or so, into the $469 to $487 range. Ultimately, though, this seems to be a really healthy retracement, and the data points to an eventual breakout past that stubborn $516 major resistance level.
Let's pivot away from tech for a moment for Section 4, Berkshire Hathaway's buyback analysis.
Looking at the Oracle of Omaha, Berkshire saw a 6% rise in operating profit to $12 billion. But the real story here is how aggressively they are buying back their own stock. After hitting pause in mid-2024, they deployed $2.35 billion in Q1, accelerated that to $4.5 billion in Q2, and dropped another $3.4 billion just in July.
Berkshire operates under a really strict rule. They only buy when cash is high, which it is, at over $200 billion, and when they believe the stock is trading below intrinsic value. Based on the data, they clearly found that deep value right in the $470 to $500 range.
Looking ahead, forward valuations put the 2026 median at $540 and 2027 at $560. At around $529 today, the stock is still slightly undervalued against those targets. This is what you'd call a classic mean reversion play. Basically, it's buying a stable, high-quality asset when it dips below its historical valuation, expecting it to slowly bounce back to the middle. It's a slow, steady core holding, definitely not a rapid growth rocket ship.
Finally, we've got Section 5, TSMC Investment Strategy Updates.
We're wrapping up our equity deep dives with the absolute bedrock of the high-performance computing world, TSMC. With Microsoft, NVIDIA, and every other tech giant pouring hundreds of billions into hardware, the million-dollar, or rather billion-dollar question is this: has this insane AI capex boom made TSMC overvalued? Well, let's look at the estimates. The 2026 forward median sits at $360, and it actually jumps to $457 in 2027. When you map current market pricing against that 2027 median, there is actually still a decent margin of safety for investors, even if the upper bound multiples are starting to look, a little bit frothy. The pricing power TSMC holds right now is practically unshakable.
So how is the smart money accumulating shares here? The strategy maps out a conservative entry between $358 and $375 to play the overhead resistance. Now, if the broader market panics and sells off, say due to bad macro data, a deeper pullback entry is waiting down near the 200-day moving average, between $320 and $350. Just keep in mind, this entire tiered accumulation strategy gets thrown completely out the window if the stock breaks out and runs above $429.
To put this into a broader portfolio perspective, a balanced model allocation places TSMC at a steady 6% weight. That ties it as a third largest holding, perfectly parallel to other megacaps like Tesla and Google. It's an incredibly disciplined way to play the massive upside of the semiconductor space without overexposing your portfolio to its notorious stomach-churning volatility.
But remember, all of these carefully mapped technical zones and corporate strategies hinge on one overarching catalyst, and that is Wednesday's CPI inflation report. If inflation comes in hotter than expected, yields will spike further and the broader market could face a severe stress test. So I'll leave you with this question. Is this incredible AI infrastructure boom strong enough to weather a hawkish Federal Reserve, or are we staring down the barrel of a major tech pullback? Let us know what you think, and thanks for watching this explainer.